Evening, ladies and gents. Simon Brown here from Just One Lap. Not doing this evening's presentation, but let me quickly do some housekeeping before we start. First off, if you can hear me and if you can see Craig's screen, if you could raise your hand in the GoToWebinar application so that we know people are seeing and hearing. Brilliant, hands coming aplenty. We're winning in that regard. As always, Power Hour, we keep it to an hour. If you've got questions, drop them into the Q&A box. We will take them at the end. So if your question's been ignored, don't stress it. We'll take it at the end. And a couple more events quickly to promote. In 2 weeks' time, I'm doing one, Porter's 5 Forces. What to look for in a company, not from a valuation or fundamental perspective, but from a business perspective. And then end of September, we're having F&B to talk around their new exchange traded notes, including a clean energy and a global water ETN and all of their individual stocks and the like. But I'll leave that there. This evening, Craig Gradage from Gradage and Mahura Investments, looking at BBBEE shares. I always forget some of the B's. He is undoubtedly the expert in the space. He knows a bunch. He'll leave us a whole bunch smarter. As I say, you got questions, drop them into the Q&A. We'll take those as well. But with that, Craig, over to you.
Great. Good afternoon, Simon, and good afternoon to everybody. Again, it feels weird talking to my computer. And, you know, I generally tend to feed off the energy of the room, and you know, if somebody's nodding, I look at that person for most of the presentation. So this is a bit weird. That's why I put a smiling lady on my picture, so just to give me some support during the presentation. But I'm looking forward to this afternoon's presentation and talking about these broad-based BEE shares. I just need to. Okay, there we go. That's the button. So I just want to kind of take you through the agenda for this afternoon. We're going to just talk briefly about GMI, who we are, what we do. And then I want to talk about and hopefully give the audience a bit of a conceptual understanding of broad-based BEE shares. In my conversation with various people, and I'm sure there's several of you on the webinar tonight, I kind of get a sense that the people's understanding and the way they tend to look at these shares, you know, that understanding is not quite there. They would sometimes look at things like the PE ratios and, you know, dividend yields, that sometimes important, but not the key issues there. Then I'm going to look at some important concepts, market concepts, general investment concepts that would be applicable in the broad-based BEE share space. And then I want to look at the different opportunities. I think that's what most people are here for, is to see what investment opportunities are there. So a brief introduction of GM Investments. We're a diversified investment advisory and wealth management company. So BEE shares, you know, we do that largely as an education thing, but we also include it and incorporate them in people's financial planning, because ultimately these investments are made within a financial planning, investment planning, or retirement planning context. So it's not something that you can look at in isolation. We offer professional financial planning services to individuals, groups, and corporates. And yeah, we've grown since we launched in the middle of the financial crisis of 2008. We've grown to over 1,500 individual and corporate clients, and currently manage about 1.6 billion of client money. Just some accolades that we've won along the way. Those of you familiar with the IntelliDex Awards, the Top Wealth Manager and Private Bank Survey, there we won that award in 2018 on our third attempt or entry into that survey. We also won Top Wealth Manager for lump sum investors, Top Wealth Manager for young professionals. And 3 of the 6 years that we've entered, we won People's Choice as Top Wealth Manager, where our clients have rated their satisfaction in terms of service and the advice In 2020, we ranked second as the top boutique manager. They changed the format in 2019. So yeah, we went from winning some awards to not qualifying a year later. We also approved as a professional practice by the Financial Planning Institute. So we're currently one of 14 practices and the only black-owned practice in the country to have that accreditation. And also we've got the Masthead phase compliance stamp. Essentially, Masthead are our compliance auditors. And yeah, to get the stamp, you need to get a minimum of 85% for every audit that they do on you in any 1 year. We get audited 4 times a year. So we're quite proud of that achievement, that we're running our practice within the requirements of the codes. And the most recent private bank and wealth manager survey, these were all the categories we could enter. And we ranked first for top financial advisor, second for the different investor archetypes. So lump sum investors, young professionals, entrepreneurs, wealthy executives. We ranked second. We ranked second as a top wealth boutique, and People's Choice became third. So that was our most recent performance in that survey. And very quickly, our individual services, it's wealth creation and wealth protection. So fairly, like I said, a comprehensive service offering. So under investment management, you'll see there the public broad-based fee share offer, education, and as I said, we do include it and incorporate it into people's investment plans and retirement plans where clients want us to. But it's a fairly comprehensive service offering. Okay, so that's GM Investments. What I want to do now, as I said, is try and give you a framework or develop a kind of a conceptual understanding for public BEE shares, so that when you start looking at these shares on your own, you kind of have the right conceptual framework that you're applying. And not looking at these as normal companies like a listed, Pick and Pay or Anglos or any other kind of operational business. These businesses are different, or these investments are quite different. So I saw this quote on Twitter about a week ago, or sometime in the week. It says, you don't have to know a man's exact weight to know that he is fat. And that was apparently something Benjamin Graham said. And at the time when I read that quote, I was busy thinking about this presentation and how I was going to frame the presentation. And the reason that quote jumped out at me is because of, if I had to bastardize the quote a bit and take a bit of liberty, is you don't have to know the exact value of a BEE share to know if it's a buy or not. And I'm going to tell you through the rest of the presentation why. But that's something I've noticed in my engagement with different people over the years, after writing articles, is people trying to say, what is this thing worth exactly? It's, why is Putumanati trading at 120 Rand? It should be trading at 200 Rand a share. Because their calculations show them that it should be trading at 200 Rand a share. So in fact, knowing the exact weight or the exact value of some of these shares is actually sometimes not very helpful, because a day later that value will change. And hopefully I can show you why. So a conceptual understanding of broad-based BEE shares. The more I think about these shares, because often I'm talking to what I would call investment lay people, so people who are professionals in their own right, they're doctors, they're lawyers, they're accountants, engineers. But when it comes to investments and broad-based PE shares in particular, they are lay people. And often the understanding around and how to think about these shares, as I said earlier, is misplaced. And thinking about it over the years, most of these people, investors that I talk to, tend to also be buy-to-let property investors. And the more I thought about it, the more I realized that your broad-based PE shares actually have a lot of parallels with buy-to-let property. So if you think about a typical buy-to-let property kind of arrangement, you've got a property which has a value. Let's assume that value is R1 million. Okay, you want to buy this property, you want to let it out, and you're going to make money that way. A very kind of popular way for people to get into investing. So the question is, how do you pay for that property, for the R1 million that the property is worth? Well, firstly, most people would negotiate some kind of discount. Okay, so I've assumed a 5% discount. And more often than not, if you go for a bank loan, the bank requires you to put some of your own money so that they can see that you also have, a bit of skin in the game and you have something to lose. So in this example, our little stylized example, you take 10% of the property value, 100,000 Rand, that's your deposit, and you take a bank loan for 850,000. Add all of that up, and that's the R1 million that you pay for the property. But now you've got a loan that needs to be repaid. So let's assume that that loan is 7 million a month. So that must be serviced. And you're going to charge the tenant a rental income of 7,500 per month. And from that, you will cover the cost of that loan. So, quite a realistic example of a sort of buy-to-let scenario. Now, if you look at a broad-based PE share structure, the kind of parallels are pretty similar. So there's an empowering company wanting to sell a stake of that company to black shareholders, and that percentage of the company that they're selling has a value, and that value needs to be paid for. So the shareholders need to find the money to pay that value. So typically you'll see there's a discount that is offered by the seller. The investing public are required to put some of their own money in. That's known as an equity contribution. And there is loan funding that's involved. So there's, in the PE share space, there's these sort of fancy and more complex structures called preference shares and vendor finance and notional vendor funding, things like that. But in kind of substance, it's a loan, it's debt funding. And that loan must be repaid as well. And your asset that you bought pays dividends, and often those dividends are used to repay the loan. Okay, so you can see that these broad-based PE shares are a lot similar to a buy-to-let property kind of situation. So the question is then, how do you make money from buy-to-let property? So if you look, this is now the full extent of my PowerPoint skill set. I could draw a block, and that block represents the value. In our example, the property is worth R1 million. We've taken out a loan of 850,000, and the difference between the property value and the loan is kind of what's called the equity that you have in that property. So if you sell the property, settle the loan, that property is worth kind of 150,000 to you. But as time moves on, so let's say 1 year later, the value of the property increases to 1.1 million. So 10% increase, good time in the property market. And because interest rates are low and you're getting more rental income than on, maybe pay a bit more off, and so your loan value a year later is 800,000. So now when you take 1.1 million, you subtract the 800,000 loan, your equity has doubled. So this is why buy-to-let property is such a popular way of investing, is because, with fairly small moves at the top and the bottom, you kind of get fairly big moves here, on the equity side. And if we look 7 years later, property continues to go up. So this property that you paid R1 million for is now worth 1.5 million. You've settled about 250,000 Rand of the loan. And effectively, your 100,000 Rand investment is now has a net asset value, equity value of 900,000. It's an 800% return. Okay, so what you are seeing happening is the gearing effects, the effect of borrowing money, buying something worth a lot more than the money that you had, and as that grows and as the loan is settled, your return on what you invest is actually a pretty good return. What I show here is an extract that I took from the MTN Zakhele Futhi prospectus. This is a copy and paste from that prospectus. Zakhele was selling 9.8 billion rands worth of MTN shares to the public, and this is how it was funded. There was equity contribution from the public, and those MTN Zakhele shareholders could reinvest some of their MTN Zakhele shares as their equity contribution. MTN offered a discount of 20%, so it's quite a generous discount. There was third-party bank funding and notional vendor finance from MTN. So you can see that the structure that you have here is very similar to the structure of a buy-to-let property. And ultimately, what we're trying to figure out is what is the net asset value? What is the price trading at? And is it therefore a buy? So this is what we're trying to figure out in the kind of BEE space. Is what does this picture look like? And does the share offer value? So before I get into that, into the different shares, there are just a few concepts that we need to kind of have an understanding of, because they are sort of present in the BEE space. So there's this concept of net asset value, which I've just explained. So it's just the assets minus the liabilities divided by the number of shares in issue. So net asset value, sometimes referred to as book value, sometimes referred to as intrinsic value. It's fairly easy to calculate. So you just subtract the liabilities from the assets, and then you compare that value to the value that you see. So once you get a net asset value per share, you can compare that to the price that share is trading at, and then make a call about whether that's an attractive investment or not. That book value, or that NAV, also helps you understand what you might claim should the company dissolve. Now that was quite important, because the initial BEE structures were set up in such a way that the companies had a kind of a fixed term, 5 years, 7 years, 10 years, and at the end of that period, those companies would dissolve and you would get the shares of the underlying empowering company. That was supposed to happen with Sasol and Zala, for example, and Eon Schlaber and Hlumisa. at the end of the period, you were going to get these African bank shares and Sasol shares. Things went wrong along the way, but that's pretty much why an understanding of book value, net asset value was important. The other issue that we need to take cognizance of is this issue of liquidity. And the reason liquidity is important and a factor is that your broad-based BE shares generally are illiquid shares. And as a result of that, if you want to sell your shares, generally, you would typically have to offer some kind of discount. So liquidity refers to the ability of the asset to be converted into cash. But that second component of liquidity, without any price discount being offered, is the crucial part. So if you look, at money in the bank's liquid, because you've got 100,000 Rand in the bank, and you want your 100,000, you get 100,000 Rand out. You don't have to offer the bank a discount to get your money out. If you're trading shares on the JSE, they tend to be quite liquid. Sometimes you may have to offer a small discount because the share is trading at 100 Rand and you want to get out quick, so you'd sell it at maybe 99 Rand 50 or 99 Rand 90 or 99 Rand a share. So it's a fairly small discount. But if you're dealing with an illiquid asset like a property, it's not uncommon for people to ask for a 10-15% discount on properties like that, or on assets like that, in that sort of scenario. So where there's a lack of liquidity, typically you have to be prepared to offer a discount when you're selling. But on the converse side is if you're buying, you typically want to pay some kind of discounted price to what that asset is worth. And the question then becomes, how big should that liquidity discount be? And I looked at several companies, anywhere between kind of 20 and 30% seems to be the sort of discount one should offer as a liquidity discount when dealing with an illiquid asset, be that asset a kind of private equity investment or be share or property or anything like that. And then there's a concept of market efficiency. Market efficiency really refers to the extent to which available information is reflected in the price of an asset. And typically, markets like the JSE, bond markets, your global markets, those tend to be fairly efficient markets. So if there's any kind of development, the prices adjust very quickly. But why market efficiency is important is because it allows you to make sensible choices. So the only way you can get above average profits over time is when there are abnormalities or where you see something that can affect a share, but the market hasn't quite gotten onto that particular piece of information. So over time, index investors will tell you that markets are efficient, so it should not be possible for investors to make above average profits. But where you have inefficient markets, then generally those offer you an opportunity to make money and excess returns. And the BE share space tends to be an inefficient market. It's becoming a lot more efficient and as the market has developed over time. But every now and again, you see pockets of inefficiency, and that presents an opportunity for investors to then take advantage of that market inefficiency and either buy or sell and make an excess return. And then just very quickly, this concept of secondary trading, because ultimately any trading you do in broad-based BE shares that happens in the secondary market And these secondary markets could be the JSE, the bond exchange, or some kind of over-the-counter platforms. But I'll actually talk about that a bit later, quite specific to the different BE shares. Okay, and then just the last point before I get into the shares is I think it's important that investors know what they are buying. Investors don't always know exactly what the underlying asset is in the BE shares that they're buying. So by way of contrast, you've got Sasol Kanyesa, which is invested in a subsidiary of Sasol Limited. So Sasol Kanyesa is invested in Sasol South Africa, and MTN Zakhele is invested in the holding company MTN Limited. Some of you may recall that Vodacom's initial deal was in Vodacom South Africa and not Vodacom Limited. So when you're trying to price the asset, it's always important to know what you're invested. In fact, you can see with Sasol, they've got Solby, which is invested at a holding company level, and Kanyesa, which is invested at a subsidiary level. Okay, so on that note, I'm going to go into the different shares because I think that's pretty much what people are interested in. And the way I've framed it this time is just to draw linkages back to that conceptual framework of buy to let, to kind of give you a sense of how to think about these shares. So the first one I want to look at is Putumanati, pretty much the granddaddy of public BE shares, one of the most well known, and certainly by far the best performing of all of them. It's invested in MultiChoice South Africa, not the listed MultiChoice group, so that's very important to bear in mind. Debt was settled 2 years earlier than expected. So MultiChoice South Africa proved to be a good tenant, paid very good dividends, and you know, they were growing quite nicely in the early 2000s, and it's a highly cash generative business. So that debt was settled quite quickly. It pays a dividend yield, historic yield of about 11.8%. The share price trading at the upper 140s now. It's paying a dividend of 22 Rand a share. So it's a fairly attractive dividend yield when you consider that the yield of the market's closer to 3%. When you consider that bond yields are closer to 7% on the short end, kind of 10% on the longer end, and your dividends are taxed at a flat 20%. So if you're a high income earner, that's quite attractive. Putumanati now owns 24.6% of MultiChoice South Africa. The profit last year was 6.2 billion. So at a 10 PE, which I think is a fairly reasonable PE assumption to make, you get a market value for MultiChoice of about 62 billion. So your Putumanati asset, roughly 15.3 billion in value. And the share is currently trading at 9.8 billion. You can see there's no debt in this scheme, so there's no debt that we need to factor in our valuation. And if you take a liquidity discount of 30% on 15.3 billion, you arrive at roughly 10 billion, just over 10 billion. So with Putumanati trading at 9.8 billion, it's actually trading fairly close to its fair value. So investors would look at this, and essentially what you're going to look at is this number. Is firstly, some investors are attracted by the fact that there's no debt inside the deal, and some investors may be looking for yield. So they're retired, or they're looking to kind of build a portfolio over time. So they're looking at dividend yielding assets that can pump cash into their portfolios that they can reinvest into other shares. So it's a fairly good kind of anchor for a B share portfolio because you get a good cash payment out of it, you get a low risk offering, and it's trading close to fair value. But some people want a bit more excitement. So then we start looking at something like MTN Zakhele Futhi, which owns 4.1% of the MTN group, MTN Limited. The debt in Zakhele Futhi is actually a fairly complex notional vendor funding structure. I think there was also that preference share structure as well. Total debt value roughly 5.6 billion. You know, MTN didn't pay dividends in the last, I think, 3 reporting periods, interims and finals. So as a result, Zakhele Futhi didn't have rental income or income coming through to settle their debt. So that debt number stayed quite high. But with MTN share price recovering, the NAV has grown in the last, certainly in the last couple of months. So you're sitting with a net asset value of around 3.6 billion. If we apply a liquidity discount of 30% on that, you're looking at a fair value of around 2.5 billion, or roughly 20 Rand a share. The market cap, actually, when I put the slide together, the market cap was at 2 billion. I think the market cap is now, for Zakhele Futhi, is now closer to the 2.5 billion. So that discount to net asset value of 45%, that's narrowed quite substantially, and the discount to fair value has almost disappeared. I think it's sitting at about 10% now. So if we look at Zakhele Futhi, you've got an asset of 9.2 billion, debt of 5.6, and a net asset value of around 29.50 Rand a share. And it's trading roughly between, the last time I looked, it was about 17, 18 Rand a share. So if we apply a discount to that because of the lack of liquidity, yeah, it's still looking reasonably, attractive. There are many who believe that the MTN share is in recovery mode, and that we should see that MTN share price running for a bit longer. There's talk of unbundling some parts of the business, the fintech part of the business. They've de-risked the group a bit by managing to get money out of Nigeria. So this is looking like the value should unlock there, but the debt is expected to stay kind of fairly stubbornly high. So you might find that if you pick up stock, if you're entering this position, you may have to accept a slightly lower discount than 30%. But if MTN does continue to recover, you should make your money back on that. Vodacom Yebo Yethu, it owns 6.2% of Vodacom Limited, roughly worth 16.2 billion. There's debt of 11.6 billion, which includes a deferred tax liability. It's primarily a CGT, capital gains tax liability there. So it's got a net asset value of roughly 4.6 billion, or 88 Rand a share, and a fair value of 61 Rand a share using a discount of 30%, a liquidity discount of 30%. It leaves us with a share price, well, we currently have a share price, I think it went to 45 Rand a share today. But when I put the slide together, it was 44 Rand a share, which was roughly a 29% discount to its fair value, and a significant 50% discount to net asset value. So Vodacom looks interesting on, or Yebo Yethu at least, looks interesting from a valuation perspective, because you're picking it up at a discount to its fair value, and then quite a wide discount to net asset value. It does pay a dividend, so there's a trickle dividend that's paid to Yebo Yethu shareholders. So a lot of the dividend they use to settle the debt. but because Vodacom is a pretty good dividend payer, it's paying a pretty decent dividend. And you know, interest rates came down 3% last year. So the cost of the debt has reduced. So they're settling debt a bit faster. I did an interesting calculation just to see, you know, if debt is fully settled and Vodacom stays at the current share price, then Yebo Yetu is worth about 307 a share, net asset value. Okay, we apply 30% discount to that's worth about 200 a share. And if Vodacom moves to 200 a share, so the underlying investment, but you're still sitting with the current debt, then Yebo Yetu goes to about 213 a share net asset value. So just showing you and just kind of reinforcing that conceptual model of the buy-to-let property scenario where you make money from both the price going up and from the settling of debt. So Vodacom Yebo Yetu certainly looks quite attractive. So well-structured deal. You know, you get the benefits of the gearing. That if the share price goes up, not by a lot, so from 140 to 200 a share, it's about a 40% move. You could see the net asset value widening quite a bit. So Vodacom Yebo Yetu at least remains my favorite at the moment. Good underlying business, good cash flow from the underlying business, cheap debt, and you get the gearing benefits over time. But remember, gearing works both ways. So if you see Vodacom pulling back, even 20%, then this can disappear quite quickly because of the amount of debt in it. So certainly one for the investor that has a bit of risk. Okay, Cecil BE ordinary shares, or known as SOLB1. This is Cecil's discounted scheme. So one SOLB share ranks pari passu with one Cecil ordinary share. So there's the same voting rights and there's the same dividend rights that a Cecil ordinary share will have. Okay, this is currently at a discount of roughly 40% to its to Cecil. Long-term average discount is 30%. So that 30% liquidity discount you see in a number of different shares. So if you look at the long-term discount, Cecil or SOLB1 would trade at about 30% below the price of Cecil. The higher discount is probably justified at the moment when you think about the risk that's in Cecil. But the thing is, if you want to make the return and benefit from the higher discount, you kind of have to go in before the discount narrows. And that's where you'll make your money. So you need to be a bit patient with this one. So value can unlock from that discount going from 40% back to 30%. But it's a perpetual scheme. So this one doesn't have a wind-up date. There's no liquidity event. So because there's no maturity date, you know, you probably have to accept the fact that you'll be holding a discounted asset for a long period of time. And for your patient investors, that wider discount actually presents you with an opportunity to lock in a serious long-term dividend yield from the share. So I think it was FNB Securities. I read a report yesterday where they said that they felt that Cecil was on a forward dividend yield of about 6.5%. And that was with Sasol trading at about 210 Rand a share. Because Sol BE get the same dividend as Sasol, if Sasol's on, and if they're right, and Sasol is on a 6.5 dividend yield, then Sol B is on a 10.5% forward dividend. So this bigger discount presents an opportunity for investors to perhaps, secure future income at a fairly decent rate. So currently the market cap's about just under 800 million, but the NAV, the net asset value, is closer to 1.3 billion. So that 40% discount. But there's no debt in this one as well. So just similar to Putumanati, there's no debt in Sol BE1. So you just got to track the discount between Sasol and Sol BE, and if the discount widens over time, that's a good strategy to buy when the discount is wide. Because when Sasol starts paying dividends again, you're certainly going to be in the pound seats. Then the latest to the party is SAB Zenzele Kabili. Kabili owns about 4.6 billion worth of ANH shares at the moment. ANH is Anheuser-Busch InBev. So the ANH share price has come down since the deal was struck. There's debt of 2.9 billion. So you have a net asset value of roughly 42 Rand a share. At fair value, if you apply a 30% discount to the 42 Rand, you get a fair value for Zenzele Kabili at 30 Rand a share. And this one's trading at a premium to net asset value. You'll see it's not the only share to be trading at a premium. I'll touch on the others later. But it's sitting at a hefty 138% premium to NAV and a 233% premium to fair value. So, yeah, there was a lot of excitement around this one. I think a lot of expectation that was built in from the previous Zenzele scheme, that I think people kind of assumed that, I remember there was one headline which said if you put 100 Rand into Zenzele, you were getting paid out 77,000 Rand at the end of the Zenzele scheme. There was a newspaper report, which was right, but one of the consequences is that it kind of misplaced, it set expectations a bit high for Zenzele Kabili, and that people didn't look at the details of Zenzele Kabili and just went in on the basis of what happened at Zenzele. And what you'll notice that if you just settle the debt on Zenzele Kabili, you get to roughly 116 Rand a share at the prevailing InBev share price. And if InBev does incredibly well and goes up 110% from where it's currently trading to about 2,000 Rand a share, you'll see that the net asset value of Kabili only goes up 79%. So you don't actually benefit from the gearing inside the deal. So currently what we have here is a share that's worth roughly 42 Rand a share and is trading at 100 Rand. So I think it goes without saying that this is probably one that it's almost certainly one that you want to avoid until that valuation, either it catches up with the InBev share price going up, so catches up on that level, or it's going to take a long time for the debt to be settled because, COVID has impacted earnings, impacted the ability of the company to pay shares. So this potentially is a much lower burn. So by the time they settle debt, you're not going to want a 16% return if you buy in today at 100 Rand a share. So certainly one to kind of avoid for now. It wouldn't be your first choice. Okay, Ukamba one is in the public space at the moment because there's an offer for the underlying business, Imperial. But with the information that's publicly available, yeah, I need to declare force majeure on this one. I'm trying to come up with a valuation. So I will show you my valuation calculations just now. But a lot of the information that I'm using is outdated because it's from the last set of financial results. And there's been meaningful development in this particular holding. And there was a circular that was posted, and I actually saw the circular, well, the announcement that the circular has been posted in my email at 4 o'clock this afternoon. So I haven't had a chance to look at that. But just to say that there's a fairly complex debt structure in place, which does make it difficult to estimate the impact of the deal. And we're dealing with outdated information. So this is a slide and evaluation that I'm going to have to update once I've had a chance to go through that circular. But from my calculations at the moment, let me just walk you through my calculations. So there are 17 million Imperial shares inside Ukamba One and 5.2 million deferred ordinary shares. So the way Ukamba worked in its initial form was that there were these deferred ordinary shares that unlocked every year. So every year, some of these deferred shares became ordinary shares on a tranche basis. And this would go on until 2025. So these are the unencumbered Imperial shares. Not totally unencumbered, but these are the Imperial ordinary shares, and these are the deferred ordinary shares. The Imperial shares at 66 Rand a share, which is the offer that's on the table, is worth 1.1 billion. And the deferred ordinary shares, they indicated a price of 219 million. And so you get a total value, asset value of 1.3 billion. But because of the fact that the share price has gone up since last year, since the offer, you would expect that the capital gains would increase. So all I did was I took the estimate for capital gains in 2019 because the share price was at a similar level. I think the share price in 2019 was roughly 70 Rand a share, and the offer is currently at 66. So all I did was just adjust the capital gains number there. So your value post the CGT is 1.3 billion. And then remember with Ukamba One is made up of Ukamba A and B shares. The A class shares are the listed shares, and the B class shares are for Imperial staff. So you've got to take the liabilities for A and B, and that comes up to roughly 700 million, which leaves you with a net asset value for Ukamba A and B of 630 million, and you've got to use all the shares in the issue for Ukamba One, which is 37.5 million, which gives you a NAV of 17 Rand a share. And like I said, I concede that I may be wrong because there's a collar structure inside the funding, the debt funding, and that's part of the deal structure. So essentially, with a collar, there's a floor and a ceiling on the value of the Imperial shares, and I can't get the details of the floor and the ceiling. So if you look at 2019 to 2020, you see that collar goes to a value of 100 million, and it's because of the big drop in the share price that took place over that period. Now with the share price recovering, potentially that collar doesn't have that. So I'm hoping those details are all in the circular. So this number could be slightly higher, but I don't think it's at 39 Rand where the share price is currently trading. So this could be another one where you've got a share that's trading at a premium to its net asset value. Again, there's a big disclaimer on this one. If I were to quote a local politician at Angaz, I don't know where this stands, but hopefully once I've looked through the circular, I can come back with an updated valuation on this one. And then the last one is Ukamba 2. So Ukamba 2, remember Ukamba 2 consists of the D and E shares. And Ukamba 2 owns 8.4% of Motus. So there's a value of 1.8 billion. There's debt of about 750 million. I'm not too sure how the debt structuring, because remember this was one deal. So if that Investec debt structuring, if Ukamba 2 is impacted by what's happened at Ukamba 1 with Imperial. So there's also a little bit of an asterisk here. So you got an estimated NAV of 28 Rand a share, or a fair value of 19 a share, and a share price of 30 Rand a share. So also trading at a 7% premium above the net asset value. But a 7% premium can disappear quite quickly. So if this share price goes up 10%, then suddenly it will be at a discount. So that one doesn't really give me any nightmares to the same extent as a Zakele. I'm just cognizant of time, so I'm going to continue. Okay, the last share I want to talk about is a share called TIP1. Stands for Transformational Investment something. My apologies to the guys at TIP1. Excuse me. The TIP1 is essentially looking at investing in listed BE shares, but of interest is the fact that they're also looking to tap into the unlisted space. So where you've got listed companies that have had BE shares that are not available in the public space, that you can't buy these shares. Invictus BE deal, okay, that one is gone. Omnia's BE deal. Kanyisa you can't buy at the moment. Exaro's deal. And then you've got some empowerment endowments that are sitting with these shares that may be looking for opportunities to liquidate some of those shares. So TIP1 is an interesting prospect in that it offers you one diversified investment and gives you exposure to a whole number of shares. So if you're somebody starting out and looking to reduce your risk, TIP1 becomes a very interesting prospect. They're also able to enter into the kind of corporate finance structures where they taking advantage of the fact that the Putumanati dividend yield is a lot higher than the cost of debt. So looking at creating structures where they can repay the loan for Putumanati shares that they buy with debt, almost re-gear that investment, which would then give you a much higher return from that share. So this is an opportunity for investors who are maybe starting out small and want to diversify. For many years, the Tembeka Capital was my favorite because it was the one B share that gave you a diversified exposure. With Tembeka Capital no longer being around, TIP1 fills that space quite neatly. Okay, so where do you find these shares? Either trading on the JSE board, on the Equity Express platform, or ZARX. Okay, so TIP1 you'll find on ZARX. On Equity Express, you'll find Putumanati and the two Ukamba shares. You'll find another share there that's not a BE share because it's an over-the-counter platform. So there's BE and non-BE shares there. And then the JSE BE board, where you can get MTN Zakele, Vodacom Yetu, Solbi One, and Zenzele Kapidi. So to trade on the JSE BE board, you need to open a stockbroking account that offers the BE contract. And that will allow you to then trade in those particular shares. Just cognizant of time, so I'm going to start wrapping up. Big picture, don't try and guess the best opportunity. Diversify. If you don't have a lot of money, buy a tip. Do not invest money that you can't afford to lose, or you may need at short notice. These are illiquid shares, so you have to offer discounts to get out, or you may take long to liquidate your position. There are no guarantees. Lumisa shareholders will tell you can lose all your money in these, if the deal goes wrong. Gearing means volatility. It means extra return, but you can have big losses as well. Understand your current financial position before you go into these particular shares. If you don't have space for illiquid shares, rather start small, and then start with something like a tip, and then over time build out into a bigger, into different specific shares. Okay, but I think the message is you can build a quality portfolio of fairly dominant companies in their relative sectors. Okay, I'm not going to go through this, but essentially the Yale Endowment Fund is one of the best performing institutional funds in the US. This is an extract from their 2009 report, that their long-time horizon is well suited to exploiting less illiquid, less efficient markets. That's where they make their excess returns. And if Yale was a BEE compliant entity in South Africa, I'm sure they'd have their boots full. Okay, this does not constitute advice, information, and that's our details. Thank you very much. Simon, back over to you.
Craig, appreciate that. Was excellent. A few questions around dividends and the like. I mean, in essence, the dividends that are going to flow in the future are going to be directly linked to the dividends coming from the main company. There'll be some debt payoff, but if a company doubles their dividend, then that goes up, and if they halve it, it goes down. That's a fair point. There's going to be that relationship between the two.
100%. So that's like your tenant. You know, COVID hits, they can't afford the full rent, they pay you less. So there's less money coming in to service the debt. But in good times, there's big demand for the place, you can push the rent up until it meets the point where the market clears. And so you have more money coming in, and you can settle debt and have some for yourself. So yes, 100%.
Perfect. And I got to say, I really like that buy-to-let analogy. Fumani's asking, does Tip One pay dividend?
Good question. I don't think so. They're growing, so I suspect they will be reinvesting a lot of the dividend to grow out that portfolio.
Cool. Fumani, I did drop the link into the chat, so you can go to their website. They've got a fair bit of detail there. You didn't touch on the Barlow World. Have you got a highlight overview of that, or no comment?
Kula sees where you can't trade it, so it's a moot point. So even if I did a valuation, it means nothing. So I think
that's fair enough.
It's a couple of years before it will list on either OTC or JSE, and then we can include it.
Okay. So it's one of those deals where initially there's essentially a lock-in and there's no transaction happening, and then they open it to transacting.
100%. No transacting and no dividend, because they're trying to settle as much debt as possible.
Yep, fair enough. Folks, then we are spot on time. I'm not seeing any more questions coming through, so I'm going to park it there. Craig Gradage, really appreciate the time. As always, appreciate the insights. Tons to be learned. As I said, I love that analogy with the buy-to-let, a ton there. A couple of folks asking around. Adam, I don't see your question. sorry, Adam, repost the question. I'll grab it. A couple of folks are saying, asking around when the video will be available. It'll be on Just One Lap, let's say later this evening. Questions coming through around the MTN when the scheme reaches maturity in 2024. Does that just then, you essentially get the underlying shares? Because I understand the MTN is at group level.
Yes, I think it may, like Yebo Yetu and Putumanati and Solbi one, become a perpetual scheme. Because if they mature it, then they would have to do another deal. And I think I must look at the detail again. I can't remember that offhand, but I seem to think that Sakele Futi was going to be a perpetual scheme as well.
Okay, gotcha.
So
I hear you on that.
So essentially 2024 would be the end of the funding period, but not the empowerment period.
Okay, so then it carries on trading. So Adam, that answers the first half. If it were to mature today at MTN at 132.90, you can go crunch those numbers. MTNZ to pay dividends. Are they not paying dividends?
No, so they said they wouldn't pay dividends to try and settle as much of the debt as possible. So after the funding period, after the funding period, then investors would start getting dividends at that point.
Yeah. Question around liquidity. Craig, and you touched on it a fair bit, but let's quickly go down that rabbit hole because it is important. I mean, I loved your point there from the Earl Endowment. You know, in fact, if you've got time on your side and you don't need you're not going to have any pressing need for the money, liquidity can work in your favor. The trick with low liquidity and why you take that discount process is that you are oftentimes it's difficult to get out. It's difficult to get out at a decent price. So you're going to have to take a squeeze or price in something. That's the risk of the liquidity. You manage that more than anything by saying, I've got a decade, I've got time on my side.
100%. So that's the thing, the liquidity, what it allows you to do.
Wonga, you're asking about investment clubs and tip one. Sorry.
Okay, so we seem to have a lag, sorry, Simon. But yeah, the liquidity discount allows you to get a higher yield over time because you don't pay 200 Rand a share for Cecil, pay 125 Rand a share for Cecil B1, and you get the same same dividend as Cecil. So when you calculate the yield, you're not getting 6%, you're getting 10%. So that's a benefit, but it's a long-term phenomenon. So over time, you do a lot better by having the long-term investment horizon.
Yeah. Wonga, you're asking about tip one allowing investment clubs to invest. They trade in an exchange, so it would be as per the exchange requirements. So you'd have to go and see. But as I said, I did drop the link to the website, so go and have a look there. It's not going to be their decision. It's going to be the exchange's decision. Short answer, if the club meets the requirements, I see no reason why not. But you're going to have to go and
just a comment on that, Simon.
The exchange there. And that is it for questions. We'll leave it there. Craig, really appreciate the time. Yeah.
Okay, cool. So just on tip one, you can buy it through Stockfeller, the app. So if your stock fails on Stockfeller, you can buy tip one through there.
Okay. Cool. Okay, there's a nice piece of insight there. We are getting some lag, which is making it a little complex, but I'm going to park it there. Craig Gradich, appreciate the time. Ladies and gents, appreciate your time this evening. Good turnout for what is a great space for investors. But take Craig's point, this is you need time on your side to really get the significant benefits, and there are some significant benefits there. But keep eyes on those discounts, because sometimes you're premium, and then in the case of the example, the SAB, you're probably better off just buying the share. Everyone, have a good evening. Stay safe. Appreciate the time all. Cheers.
Cheers.